Hi, welcome to Family Wealth Planning Partners. This is our weekly blog series, and you are watching the third part of a 5-part series that we've done on the different investment accounts. So if you haven't caught the other two, make sure you go back and watch them, and then we have 2 more after this. But today we're talking about post-tax savings accounts. We're going to first start off with the IRA. Now, we talked about the IRA in the pre-tax accounts, but you can also save in an IRA on an after-tax basis as well. So when we say after-tax basis, I think pretty much everybody knows what I'm talking about, but just in case, that means that you get paid on a Friday and you have money that's in your checking account and you want to have some of that money put into an investment account for some financial goal. That is on an after-tax basis. That's what we're talking about. So on an IRA, again, you can invest in an IRA on a pre-tax basis, but you can also do it on an after-tax basis. Now, there's one catch to investing money in an after-tax basis that I want to make sure that you keep in mind, and that if you do this on a regular basis, make sure you talk to your tax preparer about this. If you have money in an IRA or a 401k that you might eventually roll to an IRA at some point in your life, and you're also contributing to an IRA on an after-tax basis, make sure you don't ever commingle the two together, meaning put them together. If you do, there's a weird calculation or accounting calculation you have to do because you're mixing pre-tax and post-tax dollars, and it gets very complicated, and it's a formula you have to carry on throughout your life essentially. When you're taking distributions, it gets very complicated. So just make sure if you're contributing to a 401k or an IRA on a pre-tax basis, those dollars stay on a pre-tax IRA. And if you're making contributions to an IRA on a post-tax side, just make sure those are kept separate. The contribution limits for an IRA, this is 2019, are $6,000. If you're younger than the age of 50, if you're over the age of 50, you can contribute an additional $1,000. So the IRA is a good way to invest, no doubt. The second account that most people are familiar with is a Roth IRA. Roth IRA has the same contribution limits as the IRA, no difference. However, it's treated a little bit differently from a tax perspective. So you do contribute to the Roth IRA on a post-tax basis. Like the IRA, the investments within the account grow tax deferred, meaning you don't pay tax on them. So if you get dividends and interest and capital gains and things like that, you don't pay the tax then. The difference with the Roth IRA is that the distributions from the Roth are tax-free. Unlike the IRA where it's taxable, the Roth IRA is non-taxable. So that's a great thing. It's a great way to save. We have a ton of clients doing it. The issue with the Roth IRA is that you have income limitations. So for example, in 2019, if you're an individual and you make more than $133,000, you begin to phase out of the ability to contribute to a Roth. If you're a couple and you make more than $193,000 combined, then you start to phase out of being able to contribute to a Roth. However, there is an exception. Make sure that you go back and search for our blog on backdoor Roth IRAs, because there are ways around it, but you kind of got to know what you're doing, and there's a specific way you have to do it. And the other account type that we talk to a lot of clients about that sometimes can be misunderstood and not necessarily utilized to its fullest is a college 529 plan. Most clients have heard of them or maybe invest a little in them every month, but there are ways to actually take advantage of that account type. And so we walk clients through that and through the benefits behind contributing to a Roth, maybe more than what they're doing now in anticipation of college expenses. Now, here's how the college 529 plan works. There's really no contribution limits. There is a maximum, which I've never really run into a client that ever has put the maximum in, but I think it's like $239,000 is the max that you can put in college 529 plans. But for the most part, that doesn't really affect that many folks. However, here's how the taxation that works. So the contributions made into the 529 are made on an after-tax basis. The investments grow tax deferred, just like the Roth, just like the IRA. They grow tax deferred, meaning dividends and interest, things like that, you don't pay tax on. And then as long as the withdrawals are made equal to expenses for, used to be higher education, now it's, it can also be secondary education. Those withdrawals, as long as they're equal to the expenses, it's tax-free. So we work with clients to show them the impact of saving in an account like this and offsetting college expenses later down the road. So again, even if sometimes we'll have clients say, well, I don't necessarily want to pay 100% for college. I want my children to work while they're there, or I want my children to have to earn their way to their college expenses. And I don't necessarily want to pay 100% of it. There's still ways to take advantage of that investment account, and we walk clients through that. The last account that we're going to cover today is just a traditional brokerage account, what we call a non-retirement account or a non-qualified account. And that's a traditional brokerage account. You put money into it, you can invest it. The contributions are made on an after-tax basis. Now here's a little bit of difference. In a traditional brokerage account, or what we call a non-qualified account, the investments are not growing tax deferred. So as you get dividends and interest, you report those on your taxes. If you have capital gains, you pay those kind of along the way. But the distributions can be treated a little differently. So the distributions, and typically what we do is we have cash that's sitting in an account, and that's accumulation of dividends and interest over time. When clients get into distribution mode, we can take distributions out of that account, and they don't necessarily pay any taxes. Now, if we have to sell a security, for example, to create the cash to do the distribution, there could potentially be capital gains to pay there. But that's that's an account type where you're investing on an after-tax basis. You don't get the preferential tax treatment on the growth, but the distributions are treated a little differently in that, typically we just have cash and we take the withdrawals. So that is sort of the core account lineup of a post-tax investing. And the reason we sort of look at pre-tax and post-tax, again, I'm going to say this again, you'll hear me say it over and over and over if you watch a lot of these videos. It's incredibly important to have different buckets of income or different buckets of investment accounts. You've got pre-tax accounts and you have post-tax accounts. It's very important to make sure that we're allocating dollars every month, every year, however often you do it, to pre-tax accounts and post-tax accounts. And again, there's a variety of accounts in each one of those buckets. But what we're trying to do is allocate enough dollars to when you get into retirement or some point down the road when you need distribution, we're able to pull assets from different buckets. And we pull assets from different buckets depending on what the need is. And so that's all outlined in typically in a cash flow plan that we would do with the client. We'd show them the impact of their saving in a pre-tax basis and a post-tax basis, not only today from a tax standpoint, but also 20, 30 years down the road when they get into full distribution mode of the impact of them having saved money on a pre-tax and post-tax basis. So anyway, sorry that I know that was long, but it's just very important that we outline all the different accounts that are available on a post-tax basis and the importance of saving pre-tax and post-tax. The very next video that we've got, will be the fourth segment, is where to allocate $1. So what's the best account to allocate $1 all the way down to however many you save. So that's coming up next, and we'll see you next week.